In 1892, an Amish community in Lancaster County accumulated 4 times the land of their English neighbors on a single harvest income, carrying zero debt across 200 years of economic collapse. The financial industry replaced that model with one that charges you 23% to borrow your own future, and it spent decades making sure the alternative never made the curriculum. Most people assume the Amish are just frugal. They're not. They're systematic. Number 18 gets you out of the rent trap. Number 10 compounds silently. Number 1 ends the paycheck dependency entirely. The land ledger rule. Wealth advisors will tell you land is a long-term play, something you hold passively while other assets do the real work. The Amish treated land as the work. Every acre had to earn its keep before they would finance the next one. In the 1874 Holmes County, Ohio settlement, founding families purchased parcels averaging $3 per acre through pooled community funds, then immediately put every square foot into production. Those same parcels now appraise above $8,000 an acre. That is not appreciation. That is 130 years of compounding productivity on an asset nobody could repossess because nobody owed anything on it. The question that opens next is what happens to that productivity when the bank holds the deed instead of you. The clean title doctrine. A mortgage feels like ownership. The paperwork even calls you the owner. But the Amish noticed something the paperwork doesn't say. The bank can take it back, and you cannot take back a single payment if it does. The mechanism is simple. You do not buy until you can buy outright. Families in the Kishacoquilis Valley, Pennsylvania settlements of the 1910s routinely saved for 3 to 7 years to accumulate the full cash price of land rather than finance at prevailing 6% rates. A neighbor who borrowed at 6% over 30 years paid roughly 80% more for the same land. The Amish paid once. The tension left open is what you put on the land once the deed is clean, and that is exactly where Rule 18 begins. The productive acre mandate. The financial industry sells you on the idea that owning something is the achievement. The Amish thought owning something idle was a liability with better optics. Every acre had a job. Walter Colmorgan's 1942 USDA field report on Indiana Amish farmsteads found they were producing 40% more output per acre than comparable non-Amish operations of the same size, not through better technology, but through the rule that nothing sits. Idle land still generates a property tax bill. It is a parking meter running on an empty space. The 40% output premium meant the land was paying for itself and building reserves at the same time, which raises an uncomfortable question about where those reserves go when they accumulate. The zero intermediary rule. Everyone assumes the people managing your money are working for you. The fee structure suggests otherwise. Between the 1950s and 1970s, Lancaster County Amish communities operated internal loan pools that lent directly between members at 0% interest for land and equipment purchases, cutting out every bank, broker, and origination fee that existed in that market. A conventional farm loan in 1962 carried 5 to 7% interest. An Amish borrower paid nothing. On a $20,000 land purchase over 10 years, that gap was roughly $6,000 in fees that stayed inside the community instead of leaving it. Every dollar that did not go to an intermediary went back into land, tools, or the next generation's starting capital. The unresolved tension is where those retained dollars go when they accumulate faster than one family can deploy them. The congregation reserve system. Personal emergency funds are standard advice. Save 3 months, maybe 6. The Amish looked at that number and decided it was nowhere near enough. The Amish Aid Society structures, formalized in Berks County, Pennsylvania in the 1880s, pooled contributions across entire districts, creating reserves large enough to cover barn fires, crop failures, and medical costs without a single insurance premium paid to an outside carrier. By 1920, some districts were absorbing losses that would have wiped out conventional farm operations entirely. The reserve worked the way a load-bearing wall works. Your savings account is furniture. You can move furniture. You cannot move a load-bearing wall, and you do not want to. What it does not answer is who decides how large the reserve needs to be, and that answer lives in Rule 15, the deliberate population density strategy. Large families read as a cultural feature. The financial consequence is usually overlooked. Economist Donald Craybill's 1989 study of Lancaster County Amish documented a population doubling roughly every 20 years, and with each doubling, the community's collective reserve base grew proportionally while land costs per family dropped because purchasing power concentrated. Each new generation entering the system brought fresh labor, fresh contributions to the pool, and fresh demand for land that the community was already positioned to supply internally. The effect compresses across decades. A community of 40 families building a reserve builds it at one speed. A community of 400 families builds the same reserve in a fraction of the time. The mechanism scales. What does not scale automatically is making sure the next 400 families actually know how to run it, which is Rule 14's entire purpose. The Apprenticeship Capital Transfer. School teaches financial literacy as a subject. The Amish taught it as a consequence of working inside a real business every day from age 10. The 1972 Supreme Court case Wisconsin versus Yoder confirmed what Amish communities had already decided. Formal education ended at 14, and what followed was direct operational apprenticeship inside the family enterprise. By 18, most Amish young adults had logged years of real inventory management, customer negotiation, and cash flow decision-making inside a business they would eventually own. A 2003 survey by researcher Stephen Nolt found Amish business failure rates running well below national small business averages. The gap is not talent, it is reps. Reading a balance sheet for 8 years produces someone who understands balance sheets. Running one produces someone who can fix one. The protection that operating knowledge cannot provide on its own is what Rule 13 addresses, the untouchable asset principle. Liquidity is sold as safety. The Amish noticed that liquid assets disappear during the exact moments when discipline is hardest to maintain. The response was structural, not motivational. Across Ohio and Indiana Amish settlements from the 1940s onward, land was routinely held in family trust arrangements requiring consensus from multiple members before any sale could proceed. The friction was the feature. During the 1980s farm crisis that forced more than 300,000 American farm operations into bankruptcy, documented Amish land loss rates were negligible. Not because Amish farmers were better at resisting pressure, because the asset required a conversation that would not happen in a panic. The question that does not get answered here is what happens when the pressure comes not from inside the family, but from outside systems that can reach the asset anyway. The liability firewall. Most people think legal separation between personal assets and business exposure is something corporations do. The Amish built the functional equivalent without filing a single corporate document. Eric Wessner's 2010 research on Amish enterprise documented that Amish business structures in Lancaster County routinely kept productive land and personal property in separate ownership arrangements from operating businesses, meaning a failed shop did not trigger a land lien. Amish small business failure rates in Wessner's data ran significantly below the national average for comparable operations. The firewall is not complicated. It is a gap between two things that most people leave touching. What the firewall cannot protect is something that was never worth protecting to begin with, which is the whole premise behind Rule 11, the single core enterprise rule. Diversification is the first thing a financial advisor recommends. It is also the strategy most likely to produce mediocre results across many bets instead of strong results in one. The Amish furniture manufacturing cluster in Sugar Creek, Ohio, built dozens of independently profitable family operations between the 1960s and 1990s, every one of them running a variation of the same narrow model. One product category, refined over decades, sold at a premium. None were diversified. All were profitable. A 1995 regional economic survey estimated that Holmes County Amish furniture operations were generating margins 30 to 50% above the industry average for comparable non-Amish woodworking businesses. Depth produced that margin. Breadth would have averaged it away. What depth cannot survive without is a strategy for the years when the market for that one thing goes soft, and Rule 10 is built entirely around that window. The counter-cyclical reinvestment rule. Everyone knows to buy low. Nobody does it because buying low requires cash during the exact period when holding cash feels most dangerous. During the 1981 to 1983 recession, Holmes County Amish buyers documented in regional land records were purchasing distressed farmland at prices 30 to 50% below prior assessed values, while conventional buyers sat frozen. Those parcels transferred to Amish families at Depression-era prices and have remained in those families since. The strategy is not contrarian courage. It is arithmetic. An asset bought at 50 cents on the dollar earns twice the return at the same sale price. The reserve makes the purchase possible. The fixed ceiling makes the reserve available. Without the ceiling, the reserve gets spent in the good years, which is exactly the discipline Rule 9 installs. The fixed consumption ceiling. Income goes up and spending follows it. That is not human weakness. That is the default setting of every marketing system built in the last 100 years. The Amish Ordnung, the community's unwritten behavioral code, caps visible consumption at a level set by the district and enforced socially across settlements from Pennsylvania to Montana. Housing size, transportation, clothing, tools, all bounded. What that ceiling creates is automatic capital formation. Every dollar earned above the ceiling becomes investable without a decision being made. A 2001 study by researcher Cynthia Werner estimated that Amish household savings rates across surveyed districts ran between 25 and 35% of gross income compared to a U.S. average that year below 3%. The ceiling is not sacrifice. It is a structural redirect. The redirect only holds if the community enforcing it stays intact, which is what Rule 8 was designed to guarantee. The geographic clustering strategy. People choose where to live based on schools, commute, and price. The Amish chose based on transaction costs, and the math is not subtle. New Order Amish settlements established in Aylmer, Ontario in the 1953 founding deliberately sited homes, farms, and workshops within walking distance of each other, eliminating transportation overhead on every internal transaction. When a farmer needed a repair, the mechanic was half a mile away. When a workshop needed raw material, the supplier was in the same district. A 1998 economic geography paper by researcher Thomas Hartman estimated that internal transaction cost compression in clustered Amish settlements ran 15 to 20% below equivalent non-clustered rural operations. That compression is not invisible. It accumulates across every trade, every year, across every family in the district. What clustering builds is proximity. Rule 7 is about what flows through that proximity once it exists. The internal capital circulation rule. The standard advice is to put your money where it grows fastest, which almost always means somewhere outside your immediate community. The Amish ran the opposite calculation and came out ahead. A 1997 regional economic survey by economist Elam Zook estimated that Lancaster County Amish communities circulated above 70% of gross community income through internal suppliers, contractors, and loan pools before any dollar reached an outside market. Each internal transaction kept the margin local. Each local margin funded the next internal purchase. The wheel kept turning inside the fence. Money that leaves a community to earn a return outside, it comes back smaller, because the outside market takes a cut at every exit and every entry. The internal circulation rate explains the reserve growth. Rule 6 explains why the products circulating inside that system commanded prices worth circulating. The quality premium rule. Price competition is the strategy of businesses that do not trust their own product. The Amish compete on longevity and let the math do the selling. Yoder's woodshop in Shipshewana, Indiana has maintained a 200 to 400% price premium over mass-produced furniture competitors since the early 1990s, operating on waiting lists rather than discounting. The economic logic is simple. A table built to last 60 years and sold at 3 times the price of one that lasts 15 years is cheaper per year of use for the buyer and far more profitable per unit for the maker. Yoder's does not run sales. It runs a backlog. A backlog is a business that has stopped competing and started rationing. The premium requires a reputation the buyer trusts before the product arrives. Rule 5 is where that reputation gets built in a way that survives any individual making it. The generational reputation asset. A personal reputation ends when the person does. The Amish built a reputation attached to the community name instead, and it transfers without depreciation across every generation that maintains it. Midwestern agricultural suppliers in the early 20th century were documented extending net 90 credit terms to Amish buyers they had never personally met, based solely on community affiliation. The terms were better than what those same suppliers offered to established individual customers with years of transaction history. The inherited creditworthiness carried a measurable discount, estimated by agricultural historian David Weaver Zurcher in his 2001 research at roughly 15 to 20% better financing terms than comparable non-Amish farm operators received. A name that earns better terms across generations is a balance sheet entry that never shows up on a balance sheet. The mechanism for transferring it without losing it is what Rule 4 was designed to solve. The succession architecture rule. Most wealth transfers happen at death, which is also the moment when the business is most vulnerable and the heirs are least prepared. The Amish solved this by making the transfer a decade-long process rather than an event. The Gross-Doty house model, documented continuously across Holmes County, Ohio farms since the 1920s, transfers operational control to the next generation while the retiring generation remains on the property in a smaller residence, available for consultation, but removed from daily decision-making. Ownership transfers gradually in life, which eliminates the estate tax exposure on an operating business. A 1994 survey by researcher Gertrude Huntington found that Amish farm succession transitions averaged 8 to 12 years from first formal handoff to complete ownership transfer. 8 to 12 years of parallel operation before solo flight. The vulnerability that succession cannot address is the exposure created by depending on institutions that can change the rules after the handoff is complete. The institutional distance rule. Depending on a system you do not control is risk wearing a familiar face. The Amish ran this calculation in 1965 when the Social Security Administration began requiring participation from self-employed workers, including Amish farmers who had already built their own old age support system and wanted no part of the government's version. They refused. The IRS responded by seizing farm equipment from Amish operations in Pennsylvania and Indiana. The Amish still refused. The dispute ran for 23 years before Congress formally exempted self-employed Amish from the program in the 1988 Technical and Miscellaneous Revenue Act. They held position through equipment seizures and paid zero into a system they would never collect from. The institutional dependency they refused to create cannot be revoked, restructured, or means tested away from them. What they built instead to cover old age is not a fund. It is Rule 2. The productive longevity model. Retirement is sold as the finish line. Save enough, stop working, draw it down. The Amish looked at the drawdown phase and saw a design flaw. It requires the pile to be large enough that spending it never empties it, which means the only people who survive retirement without anxiety are the ones who saved far more than they needed. The documented alternative in Amish communities through the 1980s and 1990s was productive reduction rather than full withdrawal. Older members operating from the Gross-Doty house ran small-scale enterprises generating supplemental income while the main farm ran under the next generation. A 1994 survey by researcher Thomas Myers found a majority of Amish over 65 reporting active income from at least one ongoing enterprise. The pile never needed to be infinite because it was never the only source. The question that remains is what happens when individual productivity eventually does decline, and the answer has been built into the system since the beginning. The community solvency guarantee. Financial security is framed as a personal achievement. Build enough, protect enough, save enough, and you will be fine on your own. The Amish looked at that model and identified the flaw immediately. A floor you build alone is only as strong as you are on your worst year. In 1985, a fire destroyed the entire farm operation of Enos Baylor in Ronks, Pennsylvania. Within 48 hours, 400 community members had rebuilt the structure completely. No insurance claim, no loan application, no fundraiser. The community was the policy, and the policy paid out in 2 days. The floor is not charity. It functions the way a foundation functions. You do not notice it until something above it fails. When something above it fails, it is the only thing that matters. Enos Baylor did not lose his farm. He lost a building. What you just counted down through is not 20 separate habits. It is one system running in a sequence, and the sequence is the entire point. The land produces. The title stays clean. The earnings circulate inside the community before any dollar reaches an outside market. The community holds a reserve. The reserve funds the next acquisition. The acquisition passes to the next generation through a handoff that took a decade to execute and cost nothing in estate tax. And underneath every piece of it, the floor is collective, which means no single bad year, bad crop, or bad decision can break the whole structure. Most people approach this kind of list looking for the one thing they can grab and apply by Thursday. That is the financial industry's framing, not the Amish one. The Amish did not pick a tip. They built an operating logic and ran it without interruption across conditions that ended most of the financial institutions that existed when they started. You do not need all 20 to begin. Own something that earns. That is Rule 18, and it is the first load-bearing piece. Everything else in this countdown is what happens next if you do not stop.